Hello and welcome. My name is Tristan Thomas with List Academy, and in this video we're going to go over what we call capture and control portfolio strategy. Now, when we talk about the capture and control portfolio strategy, what we want to do is we want to help our clients understand how life insurance can be used to help supplement their income. Now, I was sitting down with a client a few weeks back, and we were talking about how life insurance can benefit them in retirement. And the client looked at me in a little bit of disbelief, thinking, well, how can life insurance help me in my retirement? Isn't life insurance just for my beneficiaries? Well, what I wanted to do was I wanted to help convey a message that would help them understand how life insurance can actually be used to help supplement their retirement income, but also help diversify their retirement portfolio. And this is the exact sales method that we were using. Now, we've used this method countless of times the last 4 or 5 years, and it's helped hundreds of clients understand the need for life insurance as a part of their retirement portfolio. So again, this is capture and control portfolio strategy. Now, the benefits of the capture and control portfolio strategy for the client is when we use life insurance as a part of their overall retirement portfolio, it's going to help reduce their overall portfolio risk, but also help increase their diversification. And that's what we want to do. And because of those two pieces, it's going to increase portfolio stability. Now, for you as the agent or the advisor, it's providing a comprehensive portfolio strategy for your client where you're not just an order taker on when your client is asking for a term policy or maybe a return of premium. You want to show exactly how a permanent policy can help benefit them for their retirement years. It's going to reduce a client's overall portfolio risk and effectively describe life insurance personal benefits. Again, a lot of clients don't understand how life insurance can be used as a retirement supplement. Mostly what they focus on is how it can help their beneficiaries when they pass away. So what I'm going to do, well, before we get into that, why? Why should we use this? What's the true benefit, or when should we use this? Well, when having a conversation with your client on diversifying their portfolio, you can use this simplified sales method. Because what it's doing is it's conveying a message to them that life insurance can help diversify their portfolio and they'll be better prepared for their retirement years. It also helps to strengthen your case as to why life insurance should be used to help supplement retirement with its living benefits. Remember, your client does not have a true grasp of how life insurance can help benefit them for retirement. They think life insurance is for their beneficiaries and that's it. So why? Why should we use capture and control portfolio strategy? How is this going to help our clients be better prepared for retirement? Well, what we want to do is we want to increase the diversity of their portfolio and reduce their overall risk. And a way to do that is by having life insurance as a component of their retirement strategy. So when you think of a client's overall portfolio, it's probably consisting of 3 main components. Those 3 are stocks, mutual funds, and bonds, right? People are putting that into their 401k, investing in mutual funds, bonds, maybe it's stocks. Maybe in a Roth IRA, they're putting money in. A simple IRA, a SEP IRA, things along those lines. They're probably putting money into one of those 3 components, if not all 3. But the problem there is that they're subject to market or inflationary risk, right? Not so much the mutual funds or stocks on the inflationary risk, but the market risk is still there, right? So what we want to do is increase their overall diversification, right? So we're going to break it up into, their portfolio is going to be broken up into 2 main sections, the capture section and what we call the control section. Now, what we're going to do is we're going to carve out a particular piece of our retirement portfolio, and that's going to be our control section. But the client decides as to how large that control section should be. If they're very conservative, maybe that's a much larger piece. If they're very aggressive, maybe that's a very small piece. But you should not decide. Have your client make the better decision. So what your client can do is invest in exactly what they invest in all the time on the capture section, which is all subject to market or inflationary risk. Maybe it's mutual funds, stocks and bonds, real estate, maybe it's CDs, right? But all 4 of those components right there, they're all subject to market or inflationary risk, right? So what we want to do is we want to carve out something that's opposite as to those risks. So pieces that are not subject to market or inflationary risk. And what is that piece? It's life insurance, right? Isn't life insurance not subject to market risk or inflationary risk? Depending on what type it is, maybe it's a whole life policy that has no market risk, no inflationary risk, right? That's based upon the dividend that's being paid out by the company. Maybe it's a variable universal life policy. Now that would be subject to market risk. But remember, our whole goal here is to diversify their portfolio. So we want pieces of life insurance that is not subject to market or inflationary risk. So Mr. and Mrs. Client, this is what I say, the reason why we're doing that is if we're still investing in mutual funds, stocks and bonds, real estate or CDs, and we have 2008 and 2009 happen all over again, what's going to happen? Well, what's going to happen is we're going to have roughly a 49, maybe 50% drop in the market, right? If you ask your client, how did your portfolio do in 2008 or 2009? They're going to give you a long story as into what happened to their portfolio. Maybe it dropped 40%, 50%. I've even seen upwards of 60, 65% of a drop, right? So have them connect emotionally to why they should diversify their portfolio. But then I also bring up to them is, let's just say that we had a 50% drop in your overall portfolio. Let's just say we went, to keep it simple, 100,000. Now your account value is at 50,000. What's the increase that you need to have on that portfolio just to equate back to 100,000, right? The real quick math on that is you actually need 100% growth. So for every one down percentage, you need an increase of 2. So that's why we want to protect against the downside of the market, right? So we want to be able to help diversify our portfolio, which is that control section. So the thing about the capture and control section is when the capture piece is shrinking, as it will, or as it did in 2008, 2009, what's still growing? Our control section, because that is not subject to market or inflationary risk, right? So it may be growing at a very small rate, but it's a lot better than it actually shrinking as the capture section is. But what happens if 2012 and 2013 happen all over again and we have a 50% plus increase in the market? Well, as the capture is expanding at a very fast rate, what is still expanding as well? So is the control section, right? Because again, that is not subject to market or inflationary risk. So the benefits to the client in this particular situation, it reduces the overall portfolio risk, right? Because you're carving out a section for life insurance. It increases the diversification. So if 2008, 2009 happen all over again, we're better prepared. And it increases the portfolio stability. So if we have ups and downs in the market, there's a little bit more consistency because we have that carved out section solely focused on life insurance. Now, again, the benefits of the capture and control portfolio strategy for the client is it reduces the overall portfolio risk, it increases diversification, and those two pieces together help increase portfolio stability. It's helping your client become better prepared for the retirement years. For you as the agent or the advisor, it's providing a comprehensive portfolio strategy. So you're not just the life insurance expert. What you can also be is you can help consult them on a retirement basis, which is also bringing that value-added piece that we're looking for. It reduces the client's overall portfolio risk, which helps you, because what that does is when times become uncertain, they're calling you and thanking you that they have a more diversified portfolio. And it's effectively describing how life insurance can give them personal benefits. It's that one additional step that we should take when we talk about how retirement can be used, how retirement can be supplemented with life insurance. This is exactly what the capture and control portfolio strategy does. Now again, like I said, this is the capture and control portfolio strategy. It has helped me countless times help clients understand why life insurance can be a component or should be a component for their retirement years. Again, my name is Tristan Thomas with List Academy, your life insurance sales experts.